John Keel's Stockbrokers, John Keel's Capital, and the corporate finance and strategy functions of the group. He is the chairman of the Colombo Stock Exchange.
Good morning, ladies and gentlemen. The topic today, you just heard it, but I'll just repeat it, is investor demand for environmental, social, and governance, or ESG, disclosures, implications for professional accountants in business. We have three very eminent speakers, experts on the topic. So I will not say too many words. I just want to briefly make 2 points. Firstly, in my role at John Keel's, which is a listed company, John Keel's Holdings, and has a very wide shareholder base, I meet investors very regularly, in particular institutional investors, foreign institutional investors, and I can say without any hesitation that ESG reporting has grown in importance quite immensely. It started 10, 15 years back with governance reporting or governance disclosures, but that has now evolved into what is ESG, social, environmental and social reporting as well. It is quite clear, not just even in a small market like here, but elsewhere in the more developed markets, that the extent and quality of ESG disclosures has a direct bearing on your share price. Companies that are known to have the highest standards of disclosure in this respect do trade at a premium. Second point, in a local context, the Colombo Stock Exchange, the market here, as you know, is a relatively small one. Our total market cap is less than 20 billion US dollars. It's less than 40% of GDP. However, the Colombo Stock Exchange has actively taken steps to be in line with global trends with regard to disclosures of this nature. It has been since mid-2007, it has been mandatory to make a compliance statement that all the corporate governance requirements as per the listing rules of the Colombo Stock Exchange have been complied with. It is mandatory to make that statement in the annual report, and the listing rules in detail list out the minimum corporate governance requirements. While we don't have mandatory social and environmental disclosure requirements at the moment, I'm sure that it's a matter of time before that comes in as well. So I will now move on to the main part of the session. Our expert speakers, to begin with, Dato Said Amin Al-Jeffrey. His topic today is growing investor interest in ESG disclosures. Dato Al-Jeffrey is a well-known corporate leader within the Malaysia and ASEAN circles. He is a chartered accountant from the Canadian Institute of Chartered Accountants. He has worked with ESO in Malaysia and the United States. He is currently the president of the Malay Chamber of Commerce and is also the co-chairman of the ASEAN Business Advisory Council. Dato Al-Jeffrey represents the government of Malaysia in various business councils. So if I can invite Dato Al-Jeffrey to make his presentation. Thank you.
Thank you, Mr. Chairman, for that introduction. Good morning, ladies and gentlemen. First and foremost, I would like to take this opportunity to thank the Institute of Certified Management Accountants of Sri Lanka, as well as the South Asian Federation of Accountants and the organizing committee, and in particular Professor Lakshman Watawala, as well as Mr. Muhammad Rafi, for inviting me to speak to you on this very, very important topic. Deals with environmental, social, and governance disclosure, the implications on professional accountants in business, in particular, our experience in Malaysia. The scope of my presentation to you this morning is, first and foremost, to give you a little brief outline about what corporate social responsibility is like for Malaysia. And then we go into some of the disclosures on the environment, social, as well as government as provided for the CSR, looking into some of the implications for professional accountants in Malaysia, and how then we would like to move forward. CSR in Malaysia is basically an applied business practice that gives continuous value to society by embracing good ethical values, respect for the environment, for the community, the employees, shareholders, as well as other stakeholders. And therefore, ladies and gentlemen, we are no different from anywhere else as we deal with CSR. Our focus, therefore, is on the triple bottom line to indicate good environmental practices as well as social practices with high value in terms of economic performance. Just a little outline about how businesses are being regulated in Malaysia. There are actually 3 regulatory bodies that regulate businesses in Malaysia. The first and the foremost is what we call the Securities Commission of Malaysia, which in the past has been called the Registrar of Companies. And anyone who wants to do business must first and foremost register their businesses with the CCM, or Companies Corporation of Malaysia. And this CCM, therefore, administer several acts as it relates to the business enterprises. And number 1 there would be the Companies Act 1965. There are also registration of businesses which are not public or private limited companies. There are trust companies of 1949. There are the Code of Funds, which is a Prohibition Act of 1971, as well as the Companies Amendment Act of the year 2007. The other regulator of enterprises doing business in Malaysia, which is very specific, is what we call as a Bursa Malaysia, which is basically the stock exchange. And it is a fully integrated stock exchange. And the principal activities are, of course, to provide securities exchange, futures as well as options exchange, offshore financial exchange, secondary bond market, central depository as well as safe custody of securities, and finally the Islamic market operation, sukuk and things like that. Last but not least is being the establishment of a Securities Commission, which was way back in 1993. And this, their job is, of course, to regulate and develop capital markets in Malaysia. And with that, there are several functions which I think I have enumerated there, which is also in your handout there, so I would not want to waste your time by going into all the details as far as those matters are concerned. Now, with those 3 regulatory bodies governing the way in which we do business, there are, of course, certain requirements, and these requirements keep changing, in particular as it relates to environment, social, as well as governance disclosures. In terms of environmental information disclosure, this is basically in Malaysia governed by the federal as well as local government laws. In particular, when it comes to setting up your business, of course, you need a business license, and you go to these agencies for you to be able to get your approvals for the licensing. And of course, in that process, they will want to look if you happen to set up a factory, for example, then they want to also see how your factory's operation is going to affect the environment before they even approve your license. And it requires also for you to regularly report to them as the way in which you operate your business. And not only that, they themselves will establish or carry out periodic as well as regular physical inspections of the sites of your business activities, so as to determine whether or not your protection tools and programs of the environment is continuously effective. And at the same time, the public, of course, can make complaints about your business operations, and you do the complaints to them, and they are the ones who will come and inspect and see whether or not there are corrective measures that has been taken. The areas of environmental protection, ladies and gentlemen, as conducted in Malaysia, deals basically in 4 different parts. The first one is what we call as forest and wildlife conservation. You don't simply chop off trees any way you like. Pollution management, that also include erosion of soil and areas like that. Zoning. Zoning is very, very important because you do not want to mix residential areas with business areas, and that is part of the environmental strategy that was put in place. And finally, of course, traffic flows as well as other safety requirements. We have 14 acts of parliament that deals with environmental laws, and I have listed them down there for you as part of your library. In terms of public disclosures, what we talked about just now, I'm basically very narrowed down into the practice in Malaysia, because I think earlier on we have already got quite a lot of information about how environmental protection, social disclosures that deals with good business practices have already been mentioned. So my particular presentation to you is very much narrowed down into the impact on Malaysia. Under the Environmental Quality Act 1974, there is no specific requirement for any public disclosure on the way in which you handle your environmental processes. Under the Occupational Safety and Health Act of 1994, in that act, there are disclosures that are required, in particular on your personal safety, on the nature of any major accident that are hazardous, including, of course, the potential effects on the population and the environment. We had one incident several years ago where a factory that was manufacturing some of these fireworks went into an accident, and there was a big explosion in the factory, as a result of which a lot of the gunpowders were burnt, and it does affect the environment, not just within the vicinity, but also over a wider area. And this is an area that this particular clause in the Act was then being put into place. Likewise, for environmental information from the stock exchange, again, there are no specific requirements for any disclosure of information on the environment, which has potential to influence your financial performance of a listed company. So basically, ladies and gentlemen, as far as disclosures are concerned, it is up to the companies to voluntarily disclose some of this information. On social disclosures, again, I'm narrowing it down to companies' welfare activities. If you look into several programs that a lot of bigger companies will want to do, in particular, I just give you some examples here, maybe providing financial aids, where they do give donations and scholarships, or even gifts in terms of property, equipment, or apparels, and all these aids are basically for social communities, for example, to the, what do you call it, foster homes and places like that. But they also have welfare programs for their employees, which again involves even the employees' families. And while they have all this type of social activities that they do, whether or not it is a must, an act of parliament, it is not. It is something voluntary. And whether or not they would like to disclose some of this information so that potential investors will get to know what the funds, or rather the proceeds from the investments are being put into use. Again, it is voluntary. This is something that the companies themselves will want to see whether or not this would create a great impact to enhance the, not performance, but rather the good image of their corporation. In terms of governance, this is very much subject to the Malaysian Code on Corporate Governance, which was introduced in the year 2000. The governance itself is supervised by the Securities Commission, and the Securities Commission has taken the stand to encourage the adoption of best practices rather than making it mandatory, and in particular encouraging companies that are transacting in between what we call as related parties, and there could also be cross-holdings among companies and things like that, where the control of the operation and the business of those companies are basically held in a very small group of people. And it is, those are the areas in which can affect the potential public investors, and therefore the Securities Commission do encourage some of these companies to make such disclosures. Now this year, just a couple of months ago, the Securities Commission has revised the Malaysian Code on Corporate Governance, and in that revision, the focus now is more to strengthen board structure as well as the board's composition. The emphasis is on the fiduciary duties of the board of directors, because they are the ones who are made responsible actually to steward and guard the company's interests, as well as to ensure that the company conduct their businesses in compliance with laws as well as ethical values, and to be able to also maintain an effective governance structure to ensure that there is an appropriate management of risk and a level of internal controls. Now, there are 8 broad principles that have been put through in the corporate governance. The first one is to establish a board charter. Number 2 is to strengthen the board's composition, where independent directors become very important. Reinforce the board's independence at the same time, and to foster the directors' commitment. Ensure that the financial statements have got credibility in its information, so that the reporting becomes a bit more credible. And to be able to also recognize and manage risk, to provide timely and quality disclosure, and maintain a good relationship of company and the shareholders. Now, again, as I said, ladies and gentlemen, the compliance is voluntary, but public disclosure of non-compliance has become mandatory. What are the implications then to the professional accountants in Malaysia? Well, I've put 2 broad aspects in this. One is on the financial reporting. The other one is on management and administration. As far as financial reporting is concerned, well, I think at the top of the scale there would be to ensure that there is correct accounting treatment as well as disclosure of transactions. That's very important indeed. And secondly is to ensure also that there is timely, accurate, and comprehensive reports. These are nothing new to you as accountants. You know that this is part of your accounting principle that we have to follow. In the areas of contingencies, contingent liabilities and all that, especially environmental liabilities, which is not reflected in the body of the account, but in the notes of the account, I think that's an area that we have got to be also very mindful of. And why? Because there is this impact on what we all learn as a going concern. The way in which we keep the books of accounts of any organization is on the principle of a going concern, and any such an impact may affect this going concern status, and that has got to be, of course, be mindful of by all of us as accountants. On the management and the administration side, depends on whether or not you as an accountant has been assigned the task to do some of these things. For example, to design and implement a management information system. Just now, as was presented, and as I recall my time when I was with Exxon, this is an area way back in the 60s and the 70s that has already been practiced by those big companies through what we call as corporate reports, using MIS, Management Information System, whereby you not only disclose financial information, but also non-financial information. And between those two information, you got to also split them into what we call as quantity information as well as quality information. So quality is not dealing with numbers, but more with words, but it has an impact. For example, if you deal with the environment and issues like that. The other one, of course, is to ensure that there's a proper design and implementation of the internal control system. These are things that has happened in the past, but I think it is still relevant today as well as in the future, because it tells you who has got the authority and whether or not there is an abuse of authority, whether or not there is proper disclosure. Anything that is done that is wrong, you need to be able to face the music, or rather come forward and say this is something that is not done right. Liaison duties with the authorities as well as with the public. The annual report, being the editor of the annual report where all these type of disclosures can come in. I think earlier on we can see from the Australian angle just now where a lot of those information has been created in the annual report, as well as to prepare specific reports to the Securities Commission and Bursa Malaysia. The business enterprise going concern status assurance, I think is very, very important to stakeholders. Today, we don't call it going concern anymore. We call it as a sustainability issue. And of course, I think we all are very mindful and agree with the fact that ESG disclosures can actually provide sustainability assurance. But again, it is a new thing. I don't think anyone has actually come up with a specific scope as I think it's still now in the process of being done. So because of that, the disclosures today are more or less voluntary. But there are two aspects of ensuring that there's this sustainability assurance done well. In the area of doing internal audits, where you have assurance as well as performance evaluation, you need to be able to integrate financial measures of performance with also non-financial metrics so that you can relate to the enterprise's health. Once you have done that, then I think the professional community must come together and make a stand that such a new approach, which we call as sustainable reporting and assurance, to become formally entrenched and adopted. And this is where I think professional accountants like you and I have a role to play to ensure that we can put in this design properly. So that's my take on this, ladies and gentlemen. Thank you so very much.
Thank you, Dr. Al-Jafri. Before I invite the next speaker, I would just like to ask the audience if you have any questions to please jot them down and send them across to the chair, and I can read out the questions at the end of the session. The next topic is how IFRS can enable ESG reporting. And our presenter is Mr. Naveen A. Hamid, is consulting manager of A.F. Ferguson and Company Chartered Accountants, a member of the PwC network. So if I can invite Mr. Hamid to make the presentation.
Honorable President Professor Lakshman Wadawala, President SAFA, Mr. Mohammad Rafi, distinguished speakers, ladies and gentlemen, Assalamu alaikum, Ayabuwan, and approaching Subha Udaswa Kweva. Thank you very much for inviting me here today. I am delighted to have this opportunity to contribute in this very important discussion on sustainability and social responsibility. This will be the agenda for next 25 minutes on the topic, how IFRS can enable environmental, social, and governance, ESG reporting. First of all, it is very important to understand why we are going to discuss this topic. There are two reasons to it. Number one is to drive professional accountants. As international financial reporting standards, IFRS are very close to our hearts, being professional accountants. Exploring IFRS from ESG perspective will drive professional accountants to start relating this issue with their roles, and will also strengthen the case of moving towards integrated reporting, which is the integration of financial, environmental, social, and governance reporting, and which will be the ultimate objective of tomorrow's corporate reporting. And the second reason, accounting for ecological impacts, a very big challenge. We are over-consuming the planet's natural capital by 30% every year than it can renew. And remarkably, we are depleting and destroying this wonderful asset with little idea of its economic consequences. The cost of damage, probably the most significant cost we incur, has never been taken into account fully and consistently in accounting and decision-making system. We account for our income, expenditure, financial assets with great certainty and with great precision. But our greatest assets, that is the natural capital, the social capital on which our survival and every business depend, is not accounted for at all. We have some good global excellent standards like G3.1 guidelines of Global Reporting Initiative, which tend to measure these ecological footprints in non-financial terms, like tons of carbon emitted, energy consumed, water usage, biodiversity impacts, etc. These standards have laid the foundation of ecological accounting. If we are to tackle the challenges, then it is also vital to translate this information in economic terms. Something in the words of accounting and finance. When the words financial accounting and financial reporting are combined together, the name of IFRS appears in our mind. IFRS adoption has taken a very fast pace, especially in the last decade. 2005 was the year of implementation of IFRS in all EU countries. 2009 was the year of call for implementation of IFRS as global standards by 2011. And IFRS enjoys regulatory backing in more than 100 countries of the world. These are the facts which have provided IFRS with the royal status in the era of corporate reporting. Now the question arises, do you really think that IFRS also address ESG reporting? Okay, let it put this way. Does IFRS has any provision for environmental reporting? Those who agree, kindly raise their hands. Okay, we'll explore it later. Now the next question. Is there any designated standard in the IFRS for ESG reporting? Certainly not. However, on having a closer look, there could be found numerous requirements in the IFRS capturing recognition, measurement, and disclosure of environmental aspects, especially environmental assets, environmental liabilities, and environmental expenses. In the next couple of minutes, I will show you the unsealed boxes of IFRS from the ESG perspective. If we succeed in finding such requirements, then it means that IFRS can enable ESG reporting and has the potential to provide for the basis of future integrated reporting. Due to time limitations, I will very briefly touch base on these standards. The details could be found in IFRS and in my research paper of the SAFA magazine. Let's start this with a general discussion. IFRS has some good qualitative features which can support fair presentation and disclosure of ESG matters. These are the features which you can see on the slide are accountability, relevance, materiality, faithful representation, neutrality, prudence, completeness, and comparability. The details on these can be found in the framework to IFRS. Link unwrapped. Now I will show you the linkage between IFRS and the ESG reporting as specified in these accounting standards. IAS 16, IAS 37, IAS 2, IAS 36, impairment, IAS 38, 8, IAS 41, IFRS 6, and various interpretations issued by International Financial Reporting Interpretation Committee. IAS 16